بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبي الهدى سيدنا وحبيبنا محمد صلى الله عليه وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Welcome to Introduction to Corporate Financing, and I hope you will understand it and enjoy it. Okay, today we will talk about the different sources of cash flow for the firm. I will talk about the different sources that are available for firms to raise money, to bring money. So firms have three sources of cash from which they can finance their activities. Okay, we know each firm needs money to finance their activities, to finance their investment activities and operating activities. In this chapter, we'll cover three types. The first one, debt. When we say debt, always think of loans, okay? Borrow money. Also think of bonds. Later on, we will talk about it, inshallah. But when the company issue bonds, we consider it debt. So this is the first one, debt. The second one, equity. Always when I say equity, think of shares. So the company has one way to raise money is to issue shares to investors, and the investor will pay the money to the company, right? Then we can do our activities. The third source is internally generated funds. We call it returned earnings. So this is very simple. Returning earnings is our profit from the last year, which we didn't distribute it as dividends. Okay, so at the end of the year we have profit normally, so we have two options. Either we distribute it as dividends, or you can keep it and invest it again in the company. So there is it like there is the main three sources that are available for us as a company, and this actually is a general overview of this chapter. Okay, let's start with this slide. In general, when we say financial markets, this is where we sell stocks or shares. The competitions and the financial market is very high. It's higher than the actually is higher than actually the competition in the product market. Why? Because normally for a product market you have patent, right? I mean, when you design a new product you have patent. No one can do it. It's not allowed. Like for example, if Adidas have a new shoes, no one can copy it unless they got the patent from Adidas. But in the financial market, when you have a new share or a new instrument or a new, let's say, new shares or a new security, then there is no patent. Everyone can do the same. That's why the competition is very high in the financial market. Securities, normally we sell it for the true value. So there is two things when we sell the stocks. Okay, we sell it as the true value. Okay, let's say something called true value. You raise the money as the market value, which is the correct value, no extra. This is in case the market are efficient. If the market is efficient, then the price on the screen. Okay, this is a correct price of the share. Now, if I ask, how do you determine that value? So basically, that is totally depends on demand and supply, and which actually determines the price of that particularly a product in the financial market. Okay, so for example, if there is a share just for $2, like so, Mr. A can think that maybe $2 is cheap, and Mr. B can think $2 is expensive, right? Which is why the price in the market corrects all the time, and then you get the true value of that security. Okay. Now, again, as I said, you need to remember this one. We have three sources. Everyone should remember it. The first sources is the easiest one, is internal fund. internal generated fund. This is the returned earnings. As I said before, this is the first source. If you want money, then another way is to issue shares or to issue debt, which is bond. So today we will cover all of them, inshallah. But if you think on it like rationally as a manager, if I need money, the first one I will go for is returned earnings, because this is our money from last year, right? Why not use it? So this is a first one. If this is like not enough, you can issue shares or issue bond. Most of the company in reality, they issue both of them. They issue equity and debt. Why? Because this will give them the cheapest mix to finance their activities. Okay, and we will learn this inshallah in coming few weeks. Here we just have example for this company, FedEx. They shows that how they sourcing their fund, how are they raising their money, what is their source of finance, and they have three different sources of fund are there. Internally generated fund, net of common stock issue, and net debt issue. Okay, you can say most of their money there is it from this blue line, okay, which is internally generated fund. Then they have some shares and some bonds. So obviously they need equity and debt, but it is always the profit or the return earnings is used as a priority, okay, a blue line, and that is actually makes sense. Why? Because it's cheaper, like it's your own profit. You don't have to give any interest to anything like on it. That's why it is cheaper, and that's why they prefer it, right? This is a cheaper source of financing. Let's start with the first one. Why we go for internal funds. As I said before, the first thing you think on it, like as a manager, you think of your internal fund. You prefer it. Why? Because cost of issuing securities is high. I mean, if you want to issue shares or bond or take loan, this will cost you money. Correct? So the cheapest thing is to use your own money and instead like of issuing shares. So the cost of issuing securities, like when we say securities, this is share and bonds. So when a business issues securities, whether it's a bond or shares, they incur cost in advertising, underwriting, bank charge. Raising money is not free in this case. So if you want to issue share, you need to hire a bank, and this bank will work for you. He will issue the share and he will charge you something. As a company, we will charge you fees. So definitely for me, the best thing is to use my own fund, right? And normally, when you issue new shares, you need to make some announcement, and those announcements may affect the company value. So if you announce, I want to issue, let's say, 100,000 shares, if the market perceives this news as a bad news, this will affect your company. So it depends on the situation. It shows that the current share valuation is very high and the company don't have enough money. So it is very important for companies to show that they are raising this money for the growth of the business and not business they are not able to fund their own business. Okay. Now, as I said, the first thing you need to go for internal fund. But the problem is what happens when the firm cannot finance all of its activities from the returned earnings. If the money in the returned earning is not enough, then as a manager, you need to go outside. You know, you need to go outside. I mean, you issue shares or you go to the bank. You take a loan or issue bonds. By the way, when we say blowed back, it means returned earnings. They call it blowed back, like fund you back it again in the company. Okay, so it's like you use it again. Okay, financial deficit, shortfall in funds for investment. So if this return earning is not enough to finance your activities, you need to go outside. In this case, you can issue shares to shareholders, or you can issue bonds to bondholders, or take a loan from banks. So under this one, there is two things: either you issue bonds or you borrow money as a loan. Okay, or you like do both 50-50, 30-70. It's up to you, up to them. I mean, to their company. Okay, each company have different policy. So basically, to fix this shortfall, what they do, they raise money from equity or debt. Now we will start with the second one. So we are covered now the internal fund. This is the best one, but sometimes not enough if you have a big project. Okay, equity issue. Most corporations are too large to be owned by one investor, right? That is correct. Obviously, one investor cannot hold or cannot own the whole market, right? One person cannot hold the full company and still be able to manage it. So which is why there are a lot of shareholders in the company, because it's practically impossible that a person holds like the complete business. Okay, it is possible when the business is small, but it is not possible when it is very large. Therefore, the issues took too many investors. Okay, if you check it, check all firms in the stock market in Saudi stocks market is not owned by one visitor. This is there is many investor who buy the share from company, and they're in actually here in the slides we have one example. We have here Dow. It is called Dow Jones. This is actually a stock exchange in US, and this is owned by 650,000 different investors. Different investors have invested in Dow. Now, if number of shares in the market assume it is 1.167 billion, now we want to know how much of Dow does an investor who hold one share on. What does this mean? If we have one investor, only one, and this investor hold only one share, what is this, or what is his ownership in the company or in the index? What is the percentage? Okay, if like it is one because you only one share, right? One out of what? One out of 1,167,000. So if you divide one by this many number of shares, is this much percentage of Dow? This will give you a very small amount. This one share is like so insignificant, right? That's why there no a single person is owning the complete share market. No one like in the company. There will be many shareholders. Each of them have a small amount in the company or a small ownership in the company, because it's like different companies and different shareholder and everything, and it is too big and it's too much money, right? Okay, now here we have some equity terminology or concept. We need to understand them, remember them. Let's try to understand some terms which is used in relation to equity issue right now. Okay, first of all, what is equity? Equity is shares which are issued to the shareholder in return of some money to run the business. So you raise money from the shareholders and then use that money for the operation and growth of the business. Right now, different terms which we should be aware of. Treasury stock first. What is treasury stock? Treasury stock simply means stock that has been repurchased by the company and held in its treasury. So the first one called treasury stock. This is the stock that has been repurchased by whom? By the company. and held in its treasury. So, what is the idea here? Sometimes the company itself can buy its own shares at the beginning of the issue shares to the people. Then let's say if they have enough money, they have extra money at the end of the year, and they don't have any investment to invest in, they can buy their own shares from the market, and will increase the prices of the share because there will be shortage in the market, right? Like it's again about demand and supply. If you don't have too much tomato in the market, the price will go up. Same for shares. So sometimes the companies they do the same strategy. If they have too much money and they don't have any investment opportunity, or if they believe the share price in the market is very down, it should be higher. They buy their shares and the price will go up. Like, for example, we can purchase shares from the stock exchange, right? I would like to purchase 5 shares of Apple, or 5 shares of Google, or Microsoft, and things like that, right? Sometimes Google can also purchase its own shares in the market. That means the company has invested in its own share. So this is a first concept called the treasury shares. Normally, you are find it in the balance sheet. Okay. Next issue, shares and outstanding shares. Company issue shares to raise money. We know from investors, issue shares are known as outstanding shares. So if we say issue share or outstanding, this is the same. Okay, this is a number of shares in the market. Okay, third one, something called authorized share capital. Authorized share capital, this is the maximum number of shares that a company is permitted to issue without additional shareholder approval. Normally, when they establish the company, there will be something called authorized share capital. Let's say authorized share capital is 1 million, okay? It means the company can issue up to 1 million shares. They may issue 100,000 in the first year. That's okay because they don't need too much money. The remaining will be 900,000 to issue over the life of the firm. I mean, this is authorized. This is how much you can issue, okay? You may not issue all of them, you may issue just 100,000. But this is the maximum you can issue for the company. Now, imagine if the company issue already 1 million and they want more, then they need approval. They need approval from shareholders, from the current shareholders, okay? Let's say if I am shareholders in the company and the company wants to issue you shares, they need my approval, because if they bring more shareholders, maybe or may my ownership will be lower in the company. So first, they should offer me to buy shares. If I don't have money, then they offer it to the public. Okay. Now, here we have example. I think this is a clear example. So imagine you have 100 million shares in the market. This is number of shares, not $100 million. It is 100 million shares in the market in York Stock Exchange. Now, this is already in the market, 100 million shares. Imagine the company now want to issue another 20 million in new share and repurchase 5 billion. They want to issue to 20 new. Then after that, they decide to buy another 5 from the market. Like this is like 1 month later. Now, total change in the treasury stock, what is it? We call it treasury. Do you remember from the previous slide? Treasury is the repurchase stock. So here they repurchase 5 billion, right? So its mean treasury is 5. What is the total change in the number of issued shares? So what happened to the number of issued shares? It's increased, right? Because the issue is 20 million. So this is a number of new shares issued. If we want to ask what is the total change in the number of share outstanding, like how much we have in the market, or how we now we have in the market, think on it. We have 1 million from before they issued another 20. It will be 120, right? 120. Then they repurchase 5, so the total will be in the market now 115 shares, right? Okay, we continue in equity terminology. Until now, we learned only three things: treasury stock, which is how much they repurchase, how many shares in the market, how many authorized capital for the company, another terminology called additional paid in capital. This is the difference between the issue price and bar value. So there is something called bar value for the stock and something called issue price. And any difference between them, we call it additional paid in capital. We will have one example later on, inshallah. Returned earnings, as I said before, this is the earning that is not paid out as dividends. This is the first one we covered before, is the profit from last year. You remember it? If you decide not to pay it as dividends, we call it returned earnings. We have another example here. Suppose a firm has recently issued 10 million new shares at $15 per share. The bar value, assume the bar value is one and a half. The question, what is additional paid capital? As I said before, it is a difference between two things, which is 15 and 1.5. So if you find the difference, it is 13 point, right? 5 per share, because we are talking about one share. If you want to calculate it for all shares in the market, which is 10 million, just multiply it by 10 million. Okay. Now, as they do it here, they do it the same. Instead of finding the difference before they multiply it by 10, they said no, this is 1 multiplied by 10, then this one multiplied by 10, and take the difference. Okay, this will give you the same answer, you 135 million. Okay, now there's another thing called net common equity. Net from the name, common equity. This is how much equity we have. So this is represent the total amount contributed directly by shareholders when the firm issue a new stock, and contributed indirectly when the blood bought back or repurchase part of its earnings. This is just formula. Okay, so if we ask you to calculate net income equity, you need to follow this formula. It always equal bar value plus additional paid in capital plus the return earning minus share repurchase. So this is a formula. Okay, and it is more about accounting, so you will learn it in the account unit. Okay, questions. What is the book value per share of equity for a firm with $1 million in equity? When we say in equity, it means shares. $50,000 authorized capital and 25,000 shares issue and 20,000 shares outstanding. Now, it's a tricky one. You need to know each one what is represent. Okay, so let's start. 1 million here represent what? This is the net, right? The net common equity. 50,000 here represent what? It's represent authorized share capital. We don't care about the authorized. For us, it is like how much authorized to issue. They may issue it, they may issue less, they may issue only 5,000, didn't. Okay, however, shared issue here, they issued 25,000. But if you check it, like currently, how much outstanding in the market, it's only we have 20, which means that they repurchased 5 here, correct? Because they issued the 25. But if you check the market, you will find only 20, which means by default they repurchase 5,000 shares from the market. Now, this is a just the details from the or of the questions. Now, what we want, we are looking for what is the book value per share. Okay, we need the book value. This is the formula for it. Okay, uh, book value per share. If you think on it, it is equal net common equity. You divide it always by number of share outstanding. This is the formula. Always in any unit, the same. Okay, so this is equal this divide by this. Okay, now if you apply the numbers that you're giving in these questions, okay, to this formula, this will give you $50 per share. Okay, you just apply the numbers. Okay, corporate ownership. A corporation or a company is owned by whom? By common shareholders, which is investor like shareholders from the name shareholders or stockholders. This is the people who hold the stock for people who hold the share. Hold it, okay? So this is basically investor like me and you. So normally we buy shares, right? We are the owner of the company. So if you buy a share from a company, you have a specific percentage of ownership in that company. So the owner is not the manager of the company. The manager is just an employee in the company. So this is a very important to remember. The owner of the company is shareholders or stockholders. And as an owner or owners, which is basically investors and shareholders, they are entitled to what to profit and to control the firm, right? So they have full control over the firm through the voting. Normally, they have voting once a year. We will talk about this later on, inshallah. So in the voting, you can vote whether you are with the decision for some decisions with the company or you are not profit. If you are an owner in the end of the year, uh, they will distribute a profit for you as dividends. This is in case the manager and board of directors decided to distribute dividends. If they see it's better to reinvest it, they will reinvest it. Reinvest it. So they know more than me and you because they are working with the company. Okay. Now, as I said, you have some voting rights. Shareholders exercise control over the firm by voting. When I say you have a control over the firm because you can vote, like by voting for its board of directors. So there are different types of voting patterns which are used by the company, by the shareholders when they are running the company, right? So for example, shareholders don't take activities. They don't do day-to-day activities, right? They hire a board of directors or the directors who work for the company, and they do voting for it. So they are different types of voting which companies or may follow, and it depends on company to company. So it's not about what is right or what is not right. It's about whatever the company, the shareholders think is the policy they want to take, and will take it right. Okay, the first one we call it majority voting. So what is the majority voting? Majority voting is voting in which each director is voted on separately. What is meant by this? For example, let's say there are different directors, right? Company is trying to vote its board of directors. That means nominate who will be the director of the company. So, what is the majority voting? Let's say there are three directors. So, what will they do? They like will say, okay, let's vote for Mr. A first. So, all the shareholders will vote for Mr. A. Let's say Mr. A gets 50 votes, and some people they will not vote for Mr. A. Okay. So let's say they are 100. Okay. They are all 100. Okay. So, and they only give Mr. A 50 vote. Okay. The other, some of them, let's say, vote for Mr. B. They like Mr. B take 70 votes. Okay. And let's say for Mr. C, they have 90 votes. Okay. So what's happening here? They are voting individually, separately for each director. Why they do it? Because they take decisions, business decisions. So in this case, what were they are doing? They were trying to hire a director, and for that they followed majority voting. Okay? Now, the other method could be cumulative voting. What is cumulative voting? Is uh, it is a voting in which all the votes that one shareholder is allowed to cast, they can be cast for one candidate for this. So let's say every shareholders has 100 shares. It depends how each one of them will use his votes. It's like not that he has to vote. He has 100 votes, and for each director, he will be able to use that 100. Okay, he may be like use it or not. Like for example, he will use 40 for Mr. A, 60 for Mr. B, and nothing left from his 100 vote, right? So he did not want to vote for Mr. C. So this is cumulative voting. What happened in the first one? The first method, majority, basically every shareholders, let's say they had 100 votes, so they use it all their 100 vote to vote for a director, Mr. A, and then for next one also for Mr. B, 100 votes. For the next also like the Mr. C again, like they use it again. So they have the choice. Okay, they can use all the 100 like for Mr. A and Mr. B and Mr. C. Okay, now in cumulative it depends whether he wants to use 100 votes or they don't want to use it. Okay, like there's a limited of total number of 100 votes, so that means that 100 will be split in different directors. So do you understand the difference? Like you can vote, for example, if he has a limit of 100 votes, he can choose and vote just for Mr. A, like, or all 100 votes, or he can choose a different candidates and split his 100 between many directors, right? In majority, he can choose 100 for Mr. A, and then again, he can, if he want to use 100 for Mr. B, and so on. He has that option, but in cumulative, he does not have that option. Clear? Okay. Now, just giving cumulative voting, shareholders on 100 shares of this is voting for board who are elected by cumulative voting. How many votes did the shareholders cast for Director A? If four directors are to be elected and the shareholder casts his her maximum number of votes for A. Okay, now just try to understand with cumulative and what is happening. Let's say for each director he had 100 votes, but he chose to vote a single person, right? So he used all 100, 100, 100, 100 votes just for Mr. A. So how many total votes he can give Mr. A? 400 votes. Okay? Let's move now to preferred stock. So, what we were talking about before called common stock, which is one type of stocks. Another types called preferred stocks or preference shares, and the net worth in the company as a rule. This is from accounting. It's always equal common equity plus preferred equity. So if you go to the balance sheet and you want to see how much equity is there, you need to add both shares like the common equity plus preferred equity or preferred share. This will give you the net equity in the balance sheet, right? Now, what is preferred share. Preferred shares is a share similar to common shares, but they pay fixed dividends. So, as a shareholders or investor, when you buy them, you know you are going to receive dividends for sure. But for common shares, you may receive dividends, you may not, depends on the decision of board of directors. However, preferred stock is like a contract. They are going to pay you dividends fixed every year or every 6 months. So they have advantage over common equity. That means whenever a dividend is going to be paid, they will get money first and then common shareholders. If there is actually no money left, common shareholders will not get any money, right? But preferred stock will get money or dividends before equity shareholders. So this is one major advantage. You will receive always fixed dividends. You know you are going to receive dividends. What is the other advantage here? There is some tax advantage from holding this type of shares. Basically, as per the tax rules in the US, it says that if one company buys another stocks, okay, like example from a tax perspective in the US, Google is buying Apple stock and Apple gives dividends. So whole dividends is not taxable. It is only 30% is taxable. 30% of the dividends. And this is basically it's a tax rule in the US. So to promote companies so that they buy preferred stock for other companies. Potential disadvantage, interest rate fluctuations. If there is any increases or decreases in the interest rate, this will affect the amount of dividends you receive. Because normally the amount of dividends you receive is like a percentage. They will tell you, okay, we will pay you 10% of the bar value or 10% of $100. Now, if the interest rate goes in the market to 5%, they will pay you 5% of the bar value or 5% of the value of the stock. So this is because the dividends is linked to that percentage. But let's say if in the market the interest rate is 8%, but preference shares only 5%. That means you are losing if the market rate is higher, right? So that's why a new method was introduced, which was a floating rate preferred. Like from the name floating, it means it's not fixed. Okay, that means if the market rate of interest change, let's say the market rate of interest is 8%, then the preferred stock rate will also be 8%. Then that means shareholders will not lose any money. Okay. Now we are done with the second sources. We finished the return earning. We finished equity, which is basically most importantly is the common stock. Now we will move to debt, the third source of financing. Corporate debt, when like issuing debt, companies promise to make payments and repay principal, but they have limited liability that is not always repaid. So, what's the idea here? One way for the company to raise money is to issue bonds. Now, bonds is something, think on it like a stock, but it is not a stock. It has different characteristics. Okay, when you issue this bond as a firm, you issue the bond like people will buy it. They will pay bond for you, but it's like loan. It's like investor give you a loan for the company. You need to return it one day, right? It's not like a stock. So people give you money and in return you give them some interest over the life of the bond. Plus, at the end, you return the bond to them. You return the money to them. That's why we said here when you issue debt as a company. Normally, the company issued or the government. They issued a bond. When they issue, you promise the investor to make payment for them. You will give them some interest and you will repay the amount of the loan at the end or the amount of the bond at the end of the contract. So this is very important because it's different from shares. Okay, so we say it has a limited liability. Like in case of bankruptcy, normally they pay first for whom? For debt. So the first one they give for banks or bankers, we call them lenders. Next one, bonds. Then the last one will be shareholders. Okay. Now here we have some characteristic of the debt. Our first one, interest rate fluctuations. Any change in the interest rate will affect the bond because this is the way they construct the bond. They construct the bond based on the interest rate. Think on it as a product. It's one of the products. This product depends on the interest rate in the market. Coupon, it's the interest rate. For example, they give you 5% and we have sometimes zero coupon bond. So the bond is two types, one called coupon bonds. Those type of bonds pay interest for investors. Some of them they don't pay. We call it zero coupon. Okay, so sometimes the company when they issue bond, they receive let's say $90, for example. But when they repay it again, because we said at the end of the contract, you need to return the money to the investor, you return it as 100. Now, the difference here is 10. This is the profit for the investor. This is in case we have zero coupon bond. So this is an example of zero coupon bond. You buy it at discount as a visitor. You buy it at 90 in 1 year. For example, they give you 100. So this will compensate you. It's like interest. There is another bond which is the prime rate. That means the rate is as per the rate charged by the bank. Also, labor. Now, in financial market, LIBOR is very common term, which is used as London Interbank Offered Rate. So LIBOR is another example of rate. You know, bank also need money, right? Like where will banks get the money? So bank also borrow among each other. That the bank has a customer and the customer is borrowing from the bank, let's say at 20%, but the bank does not have the money, but it's like they able to borrow at 5%. So what will bank do? It will borrow from another bank 5% and then lend it to the customer at 20% and make 15% profit. Okay, and all the central banks they use London Interbank Offered Rate. That means the rate in the which primarily all the European banks borrow from each other, and they use it like this as a basis. They follow LIBOR. Okay, so again, LIBOR is the banks want to borrow from each other. We call it LIBOR, and we use it also for derivatives. Okay, now just try to understand what is debt. Debt normally has maturity of more than 1 year, which is a long-term debt. Otherwise, if it is less than 1 year, it is a short-term debt. Maturity means that a loan gets due or complete or mature. Okay, long-term debt is funded. That means it's secured by assets. Short term debt is unsecured and it is unfunded. That means there is no security. If the company is not able to pay, then the lender cannot recover from the borrower. What the sinking fund? Basically, it's like a fund where company starts setting aside its money. So that is can repay the debt. For example, it's just like a bucket of money. Like keep saving money here so that whenever it has to pay debt, it will use this money to repay the debt before maturity. Okay, a callable bond. Bond is just like a debt. So company issues a debt for, or a bond to raise money. Basically, it will issue bond to the shareholder to raise some money. Okay. Now, what is a callable bond? Callable bond means that if a company is issuing a bond, then it has a right to call it back from the investitor that I can repay. So it has a right to repurchase the debt again at the specific price, which is agreed at the time of issuing the bond. Like, for example, if the interest rate in the market they reduce a lot and the company had issued the bond at a very high rate of 10%, and the interest rate in market is just 5%. Okay, so what happens is that in that case company says, no, I am paying 10%, but everyone is just paying 5%. So they will call the bond and buy it at a specific price. Otherwise it will be very expensive for them. So if the interest rate raised, but holders of callable bond expect the firm to buy back the debt. So if there is an interest rate raise in the market, so what do you think the company will do with the bond? Do you think it will call it back or not? Okay, like company has issued a bond at 10%, but the interest rate raised to 12%, and that in that case it is not beneficial for the company to call bond, right? Because it's already been 10%. Now some characteristics of debt. Seniority. So some company can take five different type of debt, maybe from a bank, then maybe from a local investor. So generally in that there is a seniority level. What is seniority? That whenever a company will go bankrupt, what will happen if a company goes bankrupt? So what is the sequence in which that money will be repaid? As I said, debt that may be repaid in the bankruptcy, right? That means that the debt which is the most senior will get the money first, and then the one after that, and then the one after that. So basically, in that you have seniority. If there any money left after all the debt, then only shareholder will get anything. Okay, otherwise they will get nothing. So seniority they'll take first, which is why debt is less risky. Okay, and share is more risky because it is if the company has lost all the money, shareholder will not get anything. Now, what do you mean by security? Security means that if the shares are secured or unsecured. That means if you are buying a land, so are you giving any other assets as a security to borrow that money? Available bank give you $1 million because you have given another assets. Which bank is like saying that? Okay, if you will not repay my loan, okay, and not repay me back that money, I will sell this assets. Yes, so like a collateral secured in case of default. Okay, so this is meant by security. Okay, currency and country of origin. Like in current times, people can borrow from all over the world, right? So like Australian companies may go to UK, UK companies go to US, US company go to SA. So wherever they find the cheapest money, they will borrow money from there because you have to pay interest on it, right? So you can take debt from different markets. Another example for currency and country of origin, just a type of security, which is like euro dollars. What is euro dollars? When the dollars are held in a bank outside US, for example, a US company holds its US dollars in, let's say, London Bank, it's held as US dollar. Okay, so it's known as euro dollars. It's just a term, just a terminology. Okay, another term which is normally used in the market is Eurobond. What is mean by that? It is bond which is marketed internationally. That means a bond which is sold internationally. This bond does not just for the European market or Australian market or just US market. A bond which is marketed internationally to raise funds from all the different investors all across the global. This is like it's a noun as irrelevant. Okay. Debt characteristic. There are different type of debt characteristic. Basically different things which you need to understand. It could be public or private. Publicly issued bonds means money or debt which you have raised from the public, like common people or whoever, like multiple investors in the market. Private placement, for example, even whether for debt or for shares, you're taking it from specific shareholders or a visitor and not offering to the whole public. It is only to specific set of shareholders or a visitor. Okay. Now, one very important term which is used in debt is protective covenant. What do we mean by that? Protective covenant simply means restrictions and conditions in the loan agreements. Okay, like for example, if the company is taking debt, the lender may say that, okay, you will only use this money for this business activities. You cannot use this money for private activities. So it is a condition in that loan document. So this type of conditioning or restrictions which are placed in agreement. It is a noun as protective covenant. Why protective? Because it is trying to protect the lender. Okay. Now, another thing, leases. For example, when you are taking a house on rent or anything, like you are taking long-term rental agreements, then we sign a lease and then we get a right to use it as an asset. Could be car, could be house, etc. Comfortable security is the securities which are comfortable to shares, are known as comfortable security. For example, you may issue a warrant or a comfortable bond, like a debt which may confer to equity shares at the stipulated prices or whatever. Okay, let's try just understand what is the warrant. Warrant is simply you give like a pieces of paper to the visitor and you say, okay, give me some money. You have a warrant, and I give you a right to buy the shares of my company. Let's say $20 before 31 December 2021. So this is shareholders has a right to buy those shares at $20, even if the market price is $50. That means, for example, if you get a right to buy one iPhone, let's say at only $1,000, but the market price is, let's say, like $2,000. So from the visitor point of view, like that means he has a right to buy it. So you issued a warrant, you took some money, transactions happens that time, but you give him a right to buy shares. That means this warrant is converting the security to share. That's how it is becoming a convertible security. Similarly, for the debt holders, also for the convertible bonds, that means, for example, a company has issued debt or this bond, which is debt. So it can say that, okay, after some time, you give me back my bonds and you can take some shares of the companies. So when a bond can be converted to share, it's a noun as a convertible bond. Okay. Last slide. An investor owns the bond. Okay, so investor has a bond. How much? $1,000. Now this bond can be converted to so there always an option to do it. So it says can be converted to 20 shares of this that are selling for $55 per share. So what is the market? What is the price for it? 20 multiplied by 55 is how much? $1,100, right? So it can be converted to shares and it can become $1,100. Now, if I just have the bond, how much is the bond for 1,000? But if I convert it to shares, how much is the value? 1,100. That means it is beneficial. So it says, should the investor convert one to shares? Yes, because it's the same bond which can become shares, and the value which was $1,000, it will become 1,100. So should the investor convert his bond into share? Yes, and the reason is that to be profitable, and there is no additional investment. It's just the same things. Okay, that is all for this chapter. Thank you so much. Wassalamu alaikum wa rahmatullah wa barakatuh.